Hey everybody, welcome to the morning market briefing. It's Thursday, February 9th, 2023. Hope you're doing well. Dow futures up about 0.5%, S&P up 69 basis points, NASDAQ up 1%, oil down just a little. We're going to open up today talking about a very, very strong 10-year auction yesterday, Tom. Santelli said, and I quote, "Wow." Very, very powerful auction.
Yes, the 10-year went off yesterday at 1. And as far as anybody can tell, based on historic numbers, it was about the strongest 10-year auction that I've ever seen, that Santelli had ever seen. There was just huge demand yesterday. So 80% went overseas, only 5% was left to the dealers, which is historically low. So there was just a ton of demand for it. And it's kind of hard to suss out exactly what the reason was. It could be a number of different things. The first one being with the debt ceiling negotiations going on, it could be anticipation that there's not going to be much issuance. As we reach the debt ceiling, they can only roll so much debt and issue new debt based on their financial engineering. So it's possible that people are trying to get their hands on these bonds before it becomes difficult to get in on auctions going forward, at least until we have some sort of clarity as to what they're going to do with the debt ceiling. The second piece is that expectations possibly are still very high that inflation is coming down towards the end of the year. And there was a little bit of information coming out this morning from Nicky Leaks, aka Nick Timraus, the Wall Street Journal Fed savant. That he said, quote, "Wages are actually relatively subdued and are coming down faster, according to the White House Council of Economic Advisors." And like for like, it only looks at wages that go into super core prices in effect, X housing, X service, X goods, and X management. So we're seeing essentially some signs that, wages, which is what the Fed is really worried about, are also coming down. So that could be leading into it as well. But I mean, by all accounts, people were excited to get in at about 365 on a 10-year treasury, which, to be fair, is about 30 basis points higher than we were this time last week. Because once we had the Fed decision come in, we saw rates come up, particularly on the long end. So, it could be either A, there's going to be low supply, B, people are thinking inflation coming down, or C, they thought, relatively speaking, it was a good value compared to where we've seen the 10-year over the last couple of weeks. And it probably is a combination of all three.
Yeah, it's just kind of a perfect storm where conditions were perfect. I mean, the international demand piece, is that surprising to you? I guess the debt ceiling would probably have the biggest impact there, potentially.
Yeah, I think really it's just relative value and relative credit. We're still very high. I think there's a lot of worry about the ECB fumbling the ball. I think there's a huge amount of demand coming from Asia. We've talked a ton about the JGBs and the yield curve control and all of the turnover going on with the Central Bank of Japan. And so I think that's just really people are more likely to say, hey, this is good value for good credit. We're just going to lock in for 10 years at this rate and continue to move on.
We have a 30-year auction today. I'm very curious to see how well that goes.
Yeah, my expectation is it's probably going to be strong as well. I think people are seeing that we're probably not quite to the end of the hike cycle. We're probably, I'd say 2-ish, maybe, according to futures, hikes away from the end. But I think that if you think back to the 70s when, they were raising rates aggressively, it made a ton of sense to buy, 1-year bonds with a 20 handle, but made a lot less sense to buy a 30-year bond with a 12% yield. But if you locked in at 12% for 30 years, you crushed. I mean, you absolutely dominated the stock market and everything else. So I think people are thinking that now, that as we get towards the end of the hike cycle, we want to start moving further out on the curve. And I think we're also going to be moving that direction as well.
It's like the tortoise and the hare. Yeah. I mean, you can make, back then you can make 20% for 6 months, or you could make 12% for 30 years.
Yeah. So I think that's, I don't know if we're quite there. We're definitely moving back on the yield curve, particularly with the last hike. We're seeing a lot more value towards the end of this year and early next year on the, on treasuries, especially. But, adding that mortgage-backed piece, which we talked about a lot as well, gives us that extra duration with a little bit of possibility for some upside. So that's definitely the move going forward, I believe.
I like it. Lots of earnings coming in. Let's open up with Disney, Ben. Missed on subscribers, beat on profit, stock up 7%. Bob Iger back on the call, kind of resetting expectations, resetting the tone. You were listening to the call. I was listening over the wall. What are your takeaways?
Yeah, it was a solid quarter on the cost side. I was impressed to see how much cost they were able to cut in just a month and a half since he rejoined the company. Going forward, they're pulling their subscriber guidance for a period on Disney Plus, which I think is a very good move because the previous management team was so focused on subscribers that they really cared about that and pretty much nothing else, which led to analysts caring about that and nothing else, which further created the mandate that management had to spend more to get subscribers. It was just this constant death spiral that they were in, but they're pulling subscriber guidance. But importantly, they did reiterate the profitability target for Disney Plus by the end of fiscal 24, which would be next September. So that's really good news. We now have visibility to that division breaking even, which is excellent considering that the unit lost an annualized $4.4 billion last quarter. They lost about 1.1. And again, that was a little bit better than expected, but it's still a lot of money to lose. And that money is going to start flowing back through to the company and at least be breaking even by the end of next fiscal year. But the big three takeaways I would say are, number one, they're resegmenting the company into three reporting areas. So rather than having the two reporting areas, basically all their media and entertainment and all their parks and experiences, they're going to split up the media and entertainment into Disney Entertainment and ESPN, which for a while I was thinking they're setting up to spin the ESPN unit off, but then Iger threw cold water on that later in the call, saying that they've already looked at that, not something they're considering right now. So that's number one, is the change in segmentation. Number two is they're cutting costs, primarily in the Disney Plus segment, both on the content side. They're going to cut that by $3 billion over the next few years. And they're going to cut the non-content costs as well, including layoffs, as well as lower marketing expenses. So, and primarily the marketing expenses where they're really going to cut it. So essentially what we're having is a rebalancing of the company. You know, they were so all in on Disney Plus that they really neglected some of the other pieces of their business and poured all their resources into this, frankly, money losing enterprise. So they're looking to rebalance that. And that's my third point. They're going to give some more power to creatives versus under the prior leadership. Bob Chapek gave business people kind of the keys to the city in terms of content and managing that process and managing the spend. Iger is going to go to the creative leaders like he had before and give them control over their budgets with some accountability. But they're the ones pulling the trigger on stuff, not business people. So that's kind of the prioritization. It's kind of back to basics for Disney. They're going to focus on less content, higher quality content. And I think that's all a good move. And I think it'll lead to better profitability going forward.
Yeah, I agree. Yeah, it was interesting just hearing that tone. I mean, we've talked about the Iger transition back in the CEO post. He spoke at the Schwab conference. And then like a week later was like, I'm back. So interesting to see. I think the pace and the cadence with which he's kind of downshifting to get back to the core of what that business wants to be. Affirm, the buy now, pay later platform, down about 15% now. Pre-market was down 7% during trading hours yesterday. Pretty atrocious results, kind of across the board. There's no real positive category to look at. Home furnishings and lifestyle category grew by 2%, but electronics down by 11%. All-time spend zone though from the CEO.
Yeah, I mean, this is a company that appeals to the margin on discretionary spending, because if you can't really afford something, but you want to convince yourself that you can, and you don't want to put it on a credit card, you'll split it up into multiple payments. And that's what Affirm allows you to do. And so if discretionary spending slows at the margin, these guys are the first ones to get cut. And so this is the second quarter in a row where they've reduced their guidance on gross merchandise volume and revenue. And I think that they are just a little bit diluted in recognizing their own importance in the economy and society. They say Affirm is an audacious idea, always has been. There's no well-traveled road to redefining the future of consumer finance. We are paving one. A convenient outcome for some would be for Affirm to fail. The status quo works for them. And basically says, we are fighting the good fight, allowing people to pay in 4 monthly installments
What's interesting
for something
is,
they can't afford.
what set off a red alarm in my mind was when we were at that conference in Orlando. I sat in on the presentation by Beachbody, who's the company that owns like 8-Minute Abs and P90X, and they were saying that they had rolled out a bike to compete with Peloton. And he basically said, we've got a great deal where Affirm takes the payment and then we get all the money up front. So he's like, so we sell these bikes for $2,000. Affirm gives us $2,000, and then they're responsible for going and actually getting the money from the customer over the next 2 years, which immediately set off alarm bells in my mind, which is that this money has absolutely got Affirm over a barrel because they're getting the money ahead of time, and then Affirm's on the hook for basically selling their stuff, which is probably why we're seeing this situation. Whereas people probably put the money down, the company selling the item gets the money, and then Affirm is left on.
My Peloton bike payment is through Affirm.
Oh, really?
Like it was 0% interest, and you always see that, and you're like, oh, there's some kind of fee in here, but it was like a 2-year thing, and you divide the cost of the bike plus tax by 24 months, and it was exactly what my payment to Affirm.
Yeah, so is Peloton getting all that money up front too, you think?
So Affirm takes a cut. So basically they take a commission because they help grease the wheels of the sale. So that's how their business model works. And in fairness, right now the credit quality isn't incredibly bad. They're not seeing tons and tons of defaults, although we'd be concerned about that. But it's just a tough business, and I think that people are taking a little bit more note. I mean, I don't think anyone really wants to be in a position of paying for stuff that they purchased 3 months ago, especially when that stuff was plates for the house or
it's wild the volume of products that I feel like I buy online that has an Affirm option or a similar program option, like things that aren't even, like if you buy a $2,000 bike, you're like, okay, maybe this makes sense.
$120.
Yeah, but it's like you buy a shirt for $49, and they're like, do you want to split this into monthly payments or quarterly? It's like, no, just buy it.
And that continues, and 6 months down the road, you're spending $500 a month on stuff that you've already purchased, and you're not getting anything for it. It's a really tough, pernicious thing that can crop up.
Which is wild because that's just how credit cards work.
Yeah, I think it's interesting that they consider themselves trailblazers, as if there's never been a way in which people could buy things they couldn't afford and pay for it over time. They invented debt.
Yeah.
Mattel down about 10%. Pretty brutal on everything, really. I mean, the revenue was down 19%, dolls down 24%, infant toys down 31%, action figures down 22%. Hot Wheels, the only thing that's got any kind of traction, up 10%. Just an ugly report.
Yeah, they guided to flat revenue in 2023, and I didn't quite get that after coming off a Q4 like that. But one of the big drivers in the quarter, I mean, it's not like sales are doing that well, and sales, especially toward the end of December, didn't come in like they thought they would. But a lot of it was the inventory replenishment cycle at the retailer. The retailer level is really trying to make sure they don't show any inventory on their balance sheets at quarter end. And you just saw a massive wash of inventory. So companies like Target were basically, they were not taking any inventory at the end of the year. They didn't want to post anything that they didn't have to post on their balance sheet. So if you had to return something toward the end of the quarter, you're probably not getting that return until they close the books. It's just the whole thing. It's a little bit of a game they play, but it's especially true right now because they know analysts are concerned about the inventory piece on the retailer balance sheets. Therefore, they're going to slow their purchases from companies like Mattel, and Mattel is going to be the one that eats it. Coming this year, their guidance is flat. They think that ultimate end sales are going to be up in the low mid-single digit range. They say that the consumer is pressured. They're seeing a little bit of weakness, but it's certainly not terrible.
Good stuff. Heard from several staples, Unilever, Pepsi, Philip Morris, all of these companies up just a little bit in pre-market trading, kind of ranging from about 1.5% to 3%. Ben, what are some themes you heard from them?
Yeah, I think inflation's still an issue, especially for companies like Unilever. They're seeing, this first half of the year is going to be challenged as they continue to deal with those higher logistics costs. But that'll begin to, they say we can't really give you a number right now, but we do expect that the second half of the year we should see a little bit more improved margin profile. Pepsi's just crushing it. They're putting through price increases across their business in the mid-teen percentage range. Frito-Lay. So if you're buying Doritos and Gatorade, that's you're spending a lot more money for that. Volume is flat to down on a few of those metrics.
Stuff. Lastly, bidding war for Manchester United.
Yeah,
Who are you rooting for?
This is a story that I'm following pretty closely because I'm a Manchester United fan. So you got Jim Ratcliffe, who his company is Ineos. He's a chemical engineer, and I think the wealthiest man in Britain, worth about $15 billion. He really got his start. BP got him started with a chemical plant. But he has now JP Morgan and Goldman Sachs advising him, and he's going up against the Qataris for ownership of Manchester United. Obviously, the Glazers own Manchester United right now. So I'm really curious to see where this goes. I like Jim Ratcliffe. I think he's an interesting guy. He owns Team Sky, the cycling company. He has a big position in Mercedes, the F1 team. He owns he already owns a soccer team in France called OGC Nice. He does the America's Cup. So he's a very interesting guy. I'd love for him to buy Manchester United. Hopefully he will, but we'll see what happens.
Tom, weighing in. Do you care?
No, but if he's going up against the Qataris, I mean, I had a Qatari when I was a kid and played Pong on it. It doesn't seem like it's real sophisticated, so I think he's pretty easily matched up there.
There we go. We'll end it on that note. We'll be back tomorrow morning at 8:30. Talk to you guys soon.